our favorite products right now is the small commercial and commercial lending products. Particularly on the small commercial side, we've seen huge advantages for our investors, particularly in having the ability to be able to qualify for properties without actually having to personally debt service. So a quick little explanation being, on the residential side, when you're qualifying with a conventional A or a conventional B lender, you have to be able to personally debt service the mortgage on top of all of your personal debt using your qualifiable income and whatever rental income you may have coming in from your properties. When we take a look at the small commercial side, and we're no longer factoring in your personal debt servicing. We're taking a look at the asset itself. On a 1 to 4 unit, is there enough rental income coming in to be able to support the debt on the property? So the property tax, the insurance, the utility costs, maybe some property management, and a small vacancy fee. For those buildings that have strong enough rents in there and they are able to debt service at a 1.15, 1.2 ratio, we're able to get our investors mortgages just based off of that, and we're no longer worried about personal debt servicing. So this is huge for clients that have built up a pretty decent sized portfolio. Maybe they have 5 to 8 properties. They've been turned down by the A lenders. They're tired of having a 1-year fixed rate term on the B side, and they're looking for something a little bit more long term with a little bit more competitive rate. That small commercial product is a great asset and a great tool. The rates are a lot more competitive. So they have a 1 to 5 year term. You can even go up to a 10 year if you really wanted to, but 1 to 5 years are the main terms that we're seeing. In terms of the rates, we're seeing anywhere from a 2.5 up to a 3.6% rate, and that depends on the term and whether you're looking at a fixed or a variable rate. But for the most part, it's a lot more competitive than our B lenders, and you're getting a longer term, so it's a little bit more flexible from that sense. The small commercial lending is great to keep a little bit more equity in a borrower's pocket. So one of the tools that our borrowers have used in the past to help qualify is bringing on a JV partner with some strong income to be able to help support either on the purchase or on the refinance. When we're taking a look at the small commercial side, you could be paying yourself a nominal fee on a write down, or even if you just have a standard T4 9 to 5 income. If you couldn't personally qualify, instead of bringing on a JV partner, now we can qualify based off the rental income on the property. You're going to keep all of the equity because now you no longer need to bring in that partner. So it's going to put a lot more of that equity on the takeout on the refinances for these BRRRRs back into that investor's pocket without having to share that with a joint venture partner. And keeping on like the conversation of BRRRRs, the small commercial product is a great tool because we can actually reverse engineer the numbers and tell you ahead of time how much rental income you're going to have in that unit or your units to be able to qualify for your loan amount. So say you're completing a BRRRR and it's a duplex, and you're looking to get 80 to 75% loan to value on that takeout. We can estimate the ARV, tell you how much that mortgage amount is going to be. The expenses are going to be 98% the same. You're not going to get much change, so we have those nailed down. And then we can basically just reverse engineer how much rental income needs to be in that unit or those units to be able to qualify for that mortgage and that equity takeout. Now this is beneficial because if you need a higher end rent, maybe the debt servicing isn't as quite strong or the expenses are a bit higher than usual. As a landlord that you need to maybe finish the unit with some higher end finishes. So putting a little bit of extra money in there to be able to attract that higher end tenant and get that higher rent. Or if the expenses are a little bit low and you have multiple units per se, and maybe you don't need as high rent per unit, maybe you don't need to spend as much money on the finishes, and you can kind of save a little bit money in your pocket, put that towards something else, maybe another type of renovation that you didn't quite have the funds for. But being able to reverse engineer those numbers, exactly what the steps you have to take to get there, and that's already laid out for you, versus trying to come in on the personal debt servicing side. Now you have some debt, maybe you've lined up your line of credit, your credit cards, who knows what it could be, and having to bring in that JV partner and sharing that equity. We can outline the entire steps on the small commercial side. One of the other advantages of the small commercial side is there is no property limit. The biggest thing with the conventional lending on the A and on the B side is that when you get to a certain point, a lender is going to tell you no. On the A side, it's usually around 4 or 5 properties. On the B side, you usually get that around like that 6 to 10 property mark. On the small commercial side, you can have as many properties as you want as long as your entire portfolio maintains a 1.25% debt servicing. And that means that stronger end properties can make up for weaker properties. So if you have a property that's debt servicing at, maybe say 1, and you have a property that's debt servicing at 1.5, that higher end debt servicing is going to make up for that underserviced property and kind of even out the portfolio. So no limits on the properties is a huge thing for an investor who's looking to capitalize on total passive income on cash flow in a portfolio. Some things to keep in mind with the small commercial lending. Most of our lenders are up to a 75% loan to value. So you do get a small reduction in the loan to value, but we do have a lender who can go up to 80% if the property is strong enough, and they don't have any geographical restrictions throughout Ontario, so they can lend anywhere. Just has to be good strength with the rental income. Each of our small commercial lenders has their own unique underwriting. So this isn't really a one type product fits all. There are at least 3 or 4 different ways that we could assess a property. And assessing these properties, it's very black and white. There isn't any gray area in terms of this might work. It's the numbers are there or the numbers aren't there, which is good because it allows for a really quick yes or a really quick no for some of these investors. And if it's a no, what are we looking at? Is it a private acquisition to get into the property? Find a way to get some vacancies, turn the units over, do the renovations, get those higher rents, and again, like I said earlier, we can project how much rental income we need to be able to qualify, and it's all laid out. It's a pretty smooth process. So something to keep in mind is that this product is more of a takeout type financing product. So if you're looking to complete a BRRRR, you're not going to be able to use market rents on a vacant building to help qualify. You're going to have to pick this up either privately or on maybe say a B lender and get that done conventionally. Use the market rents to help qualify, get in there, do the renovations, and then once it's completed, then we have the rents in place. We can take that to the small commercial lender, get the takeout financing, and put that in place. So one of the other advantages with the small commercial side is that it does allow you to purchase the properties in a corporation as well too. It can be a brand new corporation, can be an existing corporation. If it is an existing corporation, we are going to need to see a couple of years of financials just to assess the holding corporation and see how it's functioning. Now something else that's really great about the small commercial side too is because we're no longer worrying about personal debt servicing, this means there's a little bit more flexibility for the borrower to potentially leave that 9-to-5 job and dive fully into becoming a full-time investor. If you have a large portfolio and you're paying yourself a small dividend from your holding company, or we can just show that passive income coming in on your T1s, on your statement of rentals, the lender will consider that income coming in replace of a 9-to-5 job. So we have had some investors who've been able to quit their full-time jobs and utilize that passive income or small dividend income that they're paying themselves and continue to borrow money from these lenders. So a lot of flexibility on the small commercial side, and that option to leave their job is a huge attraction for a lot of investors these days because they want to make that full-time jump in. All in all, small commercial lending and commercial lending is kind of the end game product for investors. When you're at the point that your portfolio is large enough that you're living off your passive income, or you're at the point where you can live off your passive income and those equity takeouts, being able to quit that 9-to-5 job, moving into a full-time investor and really freeing up your time and having a product that allows you to do that is the goal for every investor, and this is that product.